Welcome to the February 23rd, 2026 advance report for McGowanGroup clients. We had promised to cover the end of the week's economic news, and I'm going to break it down for you, and also earnings, but we're also going to cover some trouble ahead, and it's going to be a big issue for the rest of the year. Now, first, economic growth. Atlanta Fed had said the fourth quarter was going to be like 5.4%. Then they said 3.7%. And we finally got the data because we had the government shutdown, 1.4% GDP growth. Wow, that's a disappointment because we went 3.8, 4.4, and it was thought it was going to be much higher. But during the government shutdown, government spending just came to a halt. 17% drop in government spending over last year. That's one of the components of GDP. I also want to get a measure on GDP, economic growth, without the government because the current administration is shrinking the government. And that may not be such a bad thing. Here, this is the CPI, the PCE, Personal Consumption Expenditures Inflation, supposedly the Fed's preferred measure. Well, 2.9%, that came in hot, 0.4% for the month versus the other estimate at 0.2%. I don't know why they have two government agencies calculating the same things and arguing about who's wrong and who's right, but this says 2.9% trailing 12 months inflation. Yeah, that's a vast improvement from 2022 when we hit 9% at one point, but it is above the Fed's target of 2%. So it means no rate cuts for now, and we'll come back to that subject. How's the economy doing? We've been hearing a lot of moaning about the jobs and how the jobs report is not as good or job openings not as good. Well, here's the most important measure, and that is how many jobless claims that there are every week, comes out every week. Well, it turns out we've been running at historic lows for unemployment claims. And you could see here during recessions, it tends to spike up. In this case, this was the shutdown, which is why the scale is so small here. But you could see 2008, 2009, it was like 500,000 people a week claiming joblessness for unemployment benefits. That was tragic. And you could see after the shutdown, it was still elevated. But since then, 200,000 is basically the historic low for the number of people that file for unemployment every week. That's a good sign. You want to see what a recession looks like? There it is. You want to see what a decent economy looks like? There it is, even though growth was anemic in the fourth quarter. New subject. We've been covering this, but I want to cover why. The reason I believe why the money flows have reversed. I go to this S&P Oil and Gas Index. It's up 23% so far this year, and the NASDAQ is down 2%. Why would that be? We got the whole big AI mania thing, and the tech companies are growing much faster. It's called valuation. And that's one reason that you want to subscribe. I'm Spencer McGowan, your financial weatherman, president and CEO of McGowanGroup Wealth Management, a team of 10 that cares, and the team right here from the Crescent in Dallas that serves affluent families. We'd love to update your plan for 2026, and you can come down and get an office tour if you're in town, or just set up a Zoom at networthradio.com. All right. This is the scary part. What's this? These are capital expenditures. Now, there's different companies to measure total capital expenditures, but look at this. Meta, Microsoft, Amazon, Alphabet, Oracle, and CoreWeave. What does it look like? Huge capital expenditures, 250 billion. Then we go over 400 billion, 2026. 700 and something billion dollars, over 700 billion, and then it goes all the way to 800 billion. Well, we did a graph for the big tech companies, This is AI generated, so I don't know how to attribute that, but thank you, Grok. Now, we verified this by hand to actually say, what's this disconnect? What this tells you in 2026, if you take the 6 big spenders, they're going to spend $600 billion in capital expenditures. Well, you know me, I want to know how much money did they make, because that sounds like a lot. Well, the 6 companies we used in our example, which overlap Google, Microsoft, and Oracle, and Meta, $600 billion going out. The earnings this past year, $500 billion. They're going to spend this is just 6 companies, spending $100 billion more than they make, and they're going to keep doing it based on the graph that we have. That's a huge problem. And you've already got companies like Blue Owl hitting the skids in their stock price because the private credit that was funding a lot of this, right, is not going to be able to get the money, because Blue Owl told us this week, hey, we're not going to let people redeem their private credit, private equity loan funds, so you can't get out. Now you're stuck. Are you going to get some more of that if you're stuck? No. The party is coming to an end, and funding the AI data center build out. It's this huge arms race. It's negative cash flow. It's very similar to what happened to energy infrastructure in 2014 when we deleted that category. We went back in too soon, by the way, but that's a different story. And it's doing the best so far this year because they don't have huge capital expenditures, and it puts the stock prices of big tech in danger because they're already at high multiples. Now, what's this? This is crude oil, up 9%. You've got the Middle East tensions, if you will, the military buildup regarding Iran, and that's one of the reasons that the oil is up. These are the pipelines. We've covered liquid natural gas, we've covered the dividend companies, and the energy infrastructure. So far this year, like we're not even 2 months done, and it's up 18%, and it has a decent yield. That to me says we've got a huge shift in those money flows, and I showed you why in that last example. How are earnings doing? This is amazing though. Underlying the broad stock market, tech may have their comeuppance from overspending, but look at this. Sales growth is 9%. Well, inflation was less than 3%. That's a huge margin. It's good for the economy when you're beating last year by that much in revenue. But now we go to earnings, that's 12%. Continued double-digit earnings growth is good news for the overall market, but the shift to deep value is underway. Thank you for tuning in. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You could see our performance track record.